Welcome back to Raising Capital. So we've talked about the funding landscape. We've talked about determining your capital needs. Now we're going to talk about how an investor thinks about approaching an investment. So basically, an investor will think through a number of different vectors or a number of different points of analysis as they meet with an entrepreneur. And having seen hundreds and hundreds of startups myself, I can attest to these sort of 9 points as being very fundamental to how I think many venture capitalists think about approaching an investment or a company. So the first is the problem. The second is the solution that company is providing. The third is the thesis, whether the thesis of the venture firm fits with the philosophy of the startup. The fourth is timing, team, technology, market, traction, and deal. So we'll now dive in and talk specifically about these 9 points. So first is the problem. So really when an investor thinks about the problem, this is what problem are you as a startup, you as an entrepreneur addressing? Now, is this a massive world-changing problem? Is this something that you know fundamentally about? Is this something that the investor personally believes in? These are a number of different ways of approaching this, but I think the clear thing to think about is your problem that you're addressing truly a heart attack rather than a headache? Meaning, is it truly a very salient pain point that people have willingness to pay? And I think this is something that every investor is going to think about off the bat is, would I use this? Is this a major problem in my life? Is this something that I truly believe in? And is something that I see the entrepreneur is truly passionate about solving? The second is around the solution. So what's the specific angle that you are taking to solve this problem in a truly unique way? So we want to know that the problem is salient, that the problem is really a heart attack rather than a headache, meaning it's very fundamental. It's something you believe in, and that you're taking a solution that's not just iterative around the margin, but is truly game changing. So something that's truly going to change this problem in a completely fundamentally new way. The third is the thesis. So institutional investors, if we think back to the capital pipeline, these are investors that are typically raising large venture funds from limited partners. And those limited partners are university endowments or pension funds. These institutional investors are often constrained by what's called the limited partner agreement, or an LPA. And basically, the LPA is an agreement between the venture firm that raises a fund and the limited partners who they borrow money from for 5 or 10 years to raise a fund and invest in startups. In the LPA, they typically specify a number of areas that they're interested in investing in, a number of areas that they think they know better than other firms. And really the LPA and the thesis that those investors have specified a number of years prior to you probably pitching them, it does factor into how they sort of approach the market, how those investors think about investing, and their personal interests. And so does your company fit with the right sectors, the right stage, and the right thesis of not just the investors, but also the firm that you're talking to? And the firm, would have created an LPA years past that would specify a number of different areas that they were interested in. So these are all sort of important constraints that are more structural to who you're pitching to, and just making sure you're pitching to not only the right firm, the right part of the capital pipeline, but also the right investor, the right general partner within a firm who, based on their track record, based on their investments in the past, seems to have a thesis fit or an interest in the same areas that you do. So this is very, very important. The fourth is timing. So the big thing with all venture or all investing is that timing is everything. So if you're too early, you're effectively wrong. So what are the specific dynamics of the market that make your idea relevant and absolutely imperative that it happen right now? So in addition to solving a big problem that's fundamental, that's a heart attack rather than a headache, in addition to having a solution that's truly unique and truly game-changing, not just iterative or around the margin, in addition to having a strong team and being part of the thesis that you're pitching to the venture capitalist, and you fit within not only the firm dynamics but the sector, the stage, and the specific thesis of the general partner that you're pitching to, timing, and this whole perception around why now, why is this imperative that it happens right now. This is probably one of the other key pieces that I think leads to a number of venture firms saying no to a company. So it could be you have a great company, you have a great problem you're solving it in a truly unique way. You fit on thesis, but the investors just don't think that right now is the perfect time, that maybe this is going to happen in 1 year or 2 years or 3 years. So I think convincing the investor that because of market dynamics, because of macro trends, that this is a trend that's happening today and that the company needs to be financed today. This is a very, very important step in convincing the investor to bet on your company. The fifth area is the team. So at the earliest stages, the team is nearly everything. So is your team truly exceptional? You guys have the smarts, the tech, the industry experience, the camaraderie, the charisma. Because really, at the end of the day, you're convincing the world and you're convincing others to believe in you. And so a number of these factors are incredibly important. So how your team came together, how you guys came to meet each other, what the combination of industry expertise, kind of novel perspective, deep technology ability, these are all factors that the investment team will think about as they evaluate not just the problem you're solving, not just the solution, but who at the earliest stage comprises the team. The sixth area is technology. So are you building truly game-changing technology with barriers to entry, stickiness, meaning it's hard to change once you've adopted it? Do you have intellectual property, meaning do you have patents, or do you have pieces of IP around the technology that you're building that would preclude others from copying you right away? And is this something that others are willing to pay for? So I think in many companies, we see, kind of early trends around willingness to pay. Even if you aren't accepting payments, if you get people to log in with credit card details or provide unique identification, leading indicators to prove that your technology is there, but there's also sort of a willingness to pay beyond that. The seventh is the market. So truly, how big is your market? Everything is $1 billion market if you look from the top down. But I think what's really important to investors is that you've thought critically about the acquisition channels to drive real scale to your business. So how is your technology going to actually build into the market? Not just what's the size of the market in aggregate, but what are the bottoms up steps you're going to take in order to acquire customers, in order to build into that market? So I think thinking about the market size, not just as a top down, so not just as XYZ market is $10 billion, and I believe I can take out 10% of that market, and therefore my market is $1 billion. It's thinking about what are the specific ways I'm going to go about acquiring customers and build into this market. And that's really the important way to frame how big your market truly is. The eighth area is traction. So what type of early traction do you have? If you're at the early stage, it's fine if you don't have millions of users. But how are you thinking about user acquisition? How are you thinking about scale? So traction is really a proxy of future value. So it signals big potential. So in all these cases, investors don't truly know, they can't read the future, but they're looking at these various inputs as proxies of value or different ways to evaluate whether or not they think this is a big idea going forward. So traction is one sort of key element of that. And finally, the ninth point is around the deal. So investors are, as I mentioned, often responsible to limited partners. So if they're institutional venture or seed firms, meaning that they've raised funds before, they have limited partners and they have models that drive how their businesses work, the same way that entrepreneurs have models that drive how their companies work. So often what this means is that a venture firm will have an ownership target or an amount of equity that it needs to take to model out, if they've got a portfolio of investments, and some of those investments do very, very well, and some of them don't work so well. If they have a portfolio approach, they need to own a specific amount of each company in order to make that work over the long run. So, the ninth point is basically how investors are thinking about not just the problem you're solving, not just the solution, not just why this is relevant now, not just about the team and the technology and the traction and the thesis, but also about what's the price of the deal, how much equity or ownership could they potentially own for a specific amount of money, and does this really jive with the model that they're working with? So, ultimately, is your company affordable enough for them? So as your homework, let's think about these 9 features. Where are you strong? Where are you weak? And where do you think you need to improve? Because I think as you walk into an investment meeting, thinking about these 9 points of evaluation will be really critical to thinking about, how you can frame your company in the best way possible, put your best foot forward, and really walk out of the investment meeting successful. Thanks. Take a breather, and we'll be back for more.